Hey, good day, everyone. Welcome to another Gables Tax Planning Group webinar. My name is Bert Salazar, and I will be your host today. Obviously, we're approaching the end of the year here in 2018. So many times what we try to do is we want to take an approach in which we're contacting many of our clients, actually all of our clients, to make sure that we've done proper tax planning, because doing a proper tax planning work prior to the end of the year is going to be very, very critical when it comes to your tax liabilities for 2018. Now, many of the clients that we engage, obviously, tax planning is very critical. And one of the major reasons why we feel that tax planning is very critical is simply that if we are able to reduce your tax liability, whether to your business or to you and your family personally, many of the clients that we engage are entering retirement. Many of them are already in retirement. So every dollar that we can save, every dollar that we can keep on your side of the ledger, when it comes to end of year tax planning, then obviously it's a lot less risk that you need to take in your investments and in your retirement portfolio. And the reason for that is simple. You know, taking tax deductions and avoiding the taxation of some of the vehicles that you may have as part of your portfolio does not require any type of risk. Therefore, if we're able to reduce your risk liability, then you're going to have more disposable income in your pocket or in your business in which you may want to dedicate or put towards something else. Now, today we're going to be talking about the end of year 2018 tax tips. And these are tax tips that we give to all our clients because we want to make certain that we can reduce their tax liability as much as we possibly can for 2018 and beyond. So some of these tips are going to be for those of you that are either self-employed or you have a business, you happen to be a business owner. And then some of the tax tips are going to be for, you know, individuals and professionals and employees that work for a corporation and so forth. So we're going to try to give you as much information as we possibly can. This is not going to be a very long webinar because obviously, you know, we want to maximize the time that we have available in front of you, but by the same token, we also want to provide the type of information that you can take with you in order to reduce your tax liability for 2018. So with that being said, obviously make sure, please, that you have water available, that you shut off your cell phone and your emails, because the information that we're going to be providing, that I'm going to be providing to all of you, I think is going to be very critical, and you're going to appreciate it quite a ways. So with that being said, I am going to go ahead and allow you to see my screen, and therefore I'm going to jump right to the presentation. You should be seeing my screen right there, so I'm going to jump to the presentation. And here we go. Again, Bert Salazar, I'm going to be your host. I'm the managing member for Gables Tax Planning Group here in South Florida. So again, all of the stuff that we're going to be covering today are going to be geared toward the reduction of your tax liabilities in 2018. So the name of this presentation, as you can see there in front of you, is Year-End 28 Tax Tips. And this is something that we're going to be covering quite a bit today during our webinar. Now, every time that I do a webinar, I like to have a thought of the day. Some of the thoughts of the day that I put into my presentations are more critical than others, but I thought that this one would be a good one, especially because of the fact that we're getting toward the end of the year. When it comes to tax planning, sometimes you're the windshield, sometimes you're the bug. And obviously all of us have experienced that, especially when we're driving down the highway. Now, what we try to do at Gables is we want to make certain that we can give you, your company, your family, the ability to always be the windshield and never be the bug. Because at the end of the day, you know who wins 99.9% of the time. The windshield is always going to beat the bug. Now, the other reason why we say that is very critical, that from a tax planning perspective, you understand that there's a major difference between tax avoidance and tax evasion. Tax avoidance are all the different tools and techniques that the IRS makes available to all tax filing Americans in order to reduce their tax liability legally on an ongoing basis. Tax evasion, you end up going to prison for many, many years, so we don't deal in that. Now, our job as tax preparers and advisors is to try to help you get as much tax avoidance as you possibly can without mitigating or violating any internal revenue rules from a business perspective. So again, what we want to try to do today is to help you become the windshield and avoid being the bug. Now, what are some of the 2018 tax highlights that we're going to be discussing today? Number one, there is a major difference between tax preparation and tax planning. The vast majority of tax preparers in the United States do tax preparation. Very few of them do tax planning. The reason for that is that tax planning requires an ongoing process. It's not something that you do overnight. It requires the identification of the marginal tax management. How are you going to be able to manage your marginal tax rate throughout the entire year? What are some of the things that you may be able to do in order to reduce your tax liability by doing proper tax management? Now, tax preparation normally occurs between January 1st and April 15th. You cannot do planning for the previous year between January 1st and April 15th. You have to pay the taxes between those dates. So therefore, the tax planning is an ongoing process that you do year in and year out in order to make certain that you prepare yourself, your family, and your business for tax reductions, not only in this year, but in subsequent years as well. So we're going to talk a little bit about the difference between tax preparation and tax planning. Please bear in mind that tax preparation is something that we do as part of the services that we provide, but every single service that we provide for our clients includes tax planning, and that's what makes our firm totally different than the vast majority of the firms that you will find out in the marketplace. Now, another issue that is very critical for all of us to understand in 2018 is that there's been a lot of changes under the Tax Cuts and Jobs Act. So obviously tax deductions, exemptions, and credits have changed. Some of them have gone away. Others have been increased. So we'll discuss those as we move forward. But at the end of the day, what you can take with you is that for 2018 and at least for the next 8 years, you're going to have higher deductions and obviously lower tax brackets. So for many Americans, that's going to be a very big plus when it comes to tax planning and tax preparation at year end. The other thing that is very critical to understand is that the TCJA, which is the Tax Cuts and Jobs Act, that was signed by President Trump in December of 2017 to take effect for the first time as of January 1 of 2018, will sunset December 31st of 2025. So whatever tax planning you may want to do in your personal life and in your business life, there's an 8-year window in which to maximize that opportunity. So a lot of the stuff that we're going to be covering today is going to deal with how to maximize those opportunities and reduce your tax liability for many, many years to come. Now, what are the tax planning rules of engagement that we engage our clients with and that we discuss with our clients with? Again, long-term planning. You have to do long-term planning if you want to reduce your tax liability over the long term. You have to be able to do income forecast. You're going to have to do expense management, whether you own a business or not. So that's the type of work that we do with our clients, because we want to keep them abreast of how to minimize their tax liability in retirement. You know, if you happen to own a business, or you happen to be self-employed, you know, reviewing your financial statements, meaning your cash flow, your income statements, your balance sheet. These are things that should be done on an ongoing basis. Now, for the business clients that we engage on a quarterly basis, usually at the end of every quarter, we are going to either do a video conference similar to what we're doing today on this webinar with our clients, or we're going to do a face-to-face meeting in which we're going to be reviewing and dissecting all of those cash flow statements, income statements, and balance sheets that are so important in order to be able to forecast and see what the future is going to look like for the vast majority of the clients that we deal with. Also, it involves a 5-year tax forward planning forecast. Now, the vast majority of tax preparers in the United States do not have the necessary software program that will allow them to do tax forwarding planning, and that's something that makes us, again, a little bit different than the vast majority of our competitors in the marketplace. Now, let's get into some of the financial and accounting tips that we're going to be discussing today. Now, these tips you can take with you. Make sure you write them down. Obviously, this is being recorded, so if any of you wants a copy of the recording, feel free to send me an email. I'll give you that information at the end with a call to action as well. But these are some of the tips that you may be able to take with you back to your accountant. If you're someone that wants to do your accounting yourself, then feel free to take this information. Or if at the end of this presentation you feel that we have brought in some value, or that I have brought some value to the table, and you want to engage me for a consultation, then obviously you'll have the ability to do so. Now, a couple of things that are very important. Make sure to review your 2018 versus your 2019 filing tax brackets. And that's where tax forwarding planning comes into play. The reason for that is, A, you may want to consider shifting certain deductions and income to 2019. So depending on what your 2018 looks like today, and now we're in November of 2018, so you have November and December to figure out and do some forecasting. You may want to either take some of the income in 2018 or defer that income to 2019, depending on what your 2019 may look like from an income perspective or a business perspective if you happen to be a business owner. Deductions and credits also have face-out thresholds. Sometimes it may be better to take the deduction in 2018 than 2019, or vice versa. So you have to work through your tax professional in order to identify whether that may be suitable for you and your business along those lines. And then obviously consider using tax forward planning calculations from a qualified tax program or a qualified tax preparer that has the ability to do tax forward planning for you, your family, and your business. Now, one of the critical things to understand for 2018 and 2019 is going to be your medical expense deductions. And some of those areas have changed under the Tax Cuts and Jobs Act of 2018, which was signed into law in 2017. For 2018 is 7.5% of your AGI, of your adjustable gross income. So any medical expenses that you have above and beyond 7.5% of your adjustable gross income, you're going to be able to deduct. 2019 is a different situation altogether, because the rules of engagement for medical expense deduction is going to change next year. So it's going to go from 7.5% to 10%. So it means that unless you have at least more than 10% of medical deductions in 2019, you're not going to be able to deduct those expenses for 2019. So if you do have some medical deductions, I would rather and I would recommend that you take the deduction in 2018 as opposed to 2019, because there's an arbitrage between 7.5% in 2018 of your adjustable gross income versus 10% of your adjustable gross income for 2019 and beyond. Now, obviously, depending on your medical expenses, again, it makes a lot of sense to do it in 2018 along those lines. So now, obviously, you know, for those of you that work for an employer that provide you with a flexible spending account, make sure that you can maximize the contribution, figure out and do a forecast as to what your medical expenses are going to be in 2018, in 2019, and then you'll be able to handle that accordingly. Some of the other tips, obviously the property taxes is called SALT. Because obviously it's a major issue that we're dealing with. Under the Tax Cuts and Jobs Act, it has been capped to a maximum of $10,000. So the state and local tax deductions. Now in Florida, it's not going to be applying as much, but in states like California, New York, New Jersey, Massachusetts, where taxes are fairly high, having a cap of $10,000 can be very critical and very detrimental for those of you that are filing taxes in those states. Now, those taxes cannot prepay, because I had a number of clients that wanted to prepay the 2018 property taxes in 2017, and many of them attempted to do that, and then the IRS came in and said time out. You cannot prepay those property taxes. So if it happened in 2017, obviously you paid the taxes at that time and you did not have that cap. But whatever took place in 2018 from a property tax standpoint, you have to pay the taxes in 2019, and the same for 2019 and so forth. So obviously those are things that are very critical to understand. But again, you know, for those of you that are in Florida or some of the other states that do not have as high property taxes liabilities to deal with because of the value of the properties and so forth, is not going to have such a major impact for those of you. But if you happen to be in those states, obviously you may have some detrimental and negative influence on that along those lines. Now, the AMT, which is the alternative minimum tax, there's been a couple of changes there as well. If you're married filing jointly, your exemption is up to $191,500. For everybody else, it's about $95,750. Now, more and more Americans are falling trapped to the AMTs for many, many years. So, you know, more and more Americans, you know, and AMT comes into play at a point in time where you may be able to take, you know, way too many deductions. And if you take way too many deductions and you go above a certain threshold, the IRS is going to come in and hit you with the alternative minimum tax, which now will take away some of those deductions and will increase your tax liability for that year. Again, if you happen to be a high income earner that has the ability to take large deductions, and obviously you're going to be more susceptible to this issue than many other Americans along those lines. Now, long-term capital gains, obviously, if you have a choice, taking a long-term capital gain is much better, because the tax brackets for long-term capital gains have always been lower than for traditional income tax brackets. In 2018, and then under the new TCJA, you know, the tax bracket has been separated. So you have the ordinary income tax brackets, and then you have the long-term capital gains brackets. You see there that could be, you know, 0%, 15%, or 20%. Many times when I ask a potential client, what is their capital gains tax bracket, everyone jumps and says 20%, and that is not necessarily the case. As a matter of fact, you know, very few Americans, unless you're fairly wealthy, will fall into the 20% capital gains tax bracket calculation. So it's critical that you understand where you're going to fall in because you may be able to do some work around that in order to reduce your tax liability in 2018. Now, what are some of those things? Well, one of the things that you can do is consider, loss harvesting, but you have to make certain that you can avoid the wash sales. What do I mean by loss harvesting? Let's say that you have a portfolio of investments in 2018. And you want to reduce the tax liabilities because you've done fairly well in 2018. Well, if you have a portfolio of investments where you may have stocks or mutual funds where you have suffered losses in 2018, then you may have the ability to sell that portion of the portfolio with a loss in order to be able to report those losses in 2019 for the 2018 tax year. Now, you have to be careful if you sell off the portfolio, because I have seen it a number of times where a client may want to sell off a stock in a year in which they had a loss in that stock, but then they go ahead and sell the stock and then buy the same stock back within 30 days. If you do that, the IRS will consider that to be a wash and will apply the wash rule to you. Therefore, you're not going to be able to take the loss tax deduction, although you sold the stock, because you bought it right back within a 30-day period. So you have to be very careful how you do that. The other thing is, if you sell a stock at a loss, or if you sell a mutual fund at a loss, that would be a capital loss. Now, you can offset capital losses with capital gains 100%. But if you don't have any capital gains, or if you don't want to exercise any capital gains for that given year, in this case 2018, in order to minimize your tax liability, then the IRS does give you the ability to offset a percentage of your capital losses against ordinary income. And in this case, the most that you could offset would be $3,000 against ordinary income. The other thing that you want to do if you want to avoid taxation or reduce your taxation in 2018 would be to avoid the sale of a profitable stock or an investment, could be a piece of real estate or whatever it may be. Or if you have to sell it because you have no choice, then instead of making a full sale, you may want to do a partial sale and then pay a portion of the taxes in 2018 and then do the rest of the sale in 2019. And then obviously you can pay it at that point in time. So these are some of the accounting tips that I think are very critical and will assist you in minimizing your tax liability in 2018. Now, I want to talk a little bit about the three taxable buckets. The IRS pretty much, places any income and any investment, any revenues that you generate primarily into three buckets. You have on the left-hand side there, you have the taxable bucket. In the middle, you will have your tax-deferred bucket. And on the far right, you'll have your tax-free bucket. Now, the taxable bucket, that's where your CDs, your savings accounts, your traditional mutual funds, your checking account falls into play. And obviously it's a very liquid bucket, so you have access to your money at all times. But from a taxable standpoint, it is not a very good bucket to have. So there's some limitations that I'll talk to you in the next few minutes about, and I'll share some of the feedback on that. So you have to be very careful as to how much money you're going to maintain in your taxable bucket. Now, the tax-deferred bucket, many of you, most Americans, and the vast majority of my clients understand quite clearly, and that's your tax-deferred bucket. That's where your qualified plans go into place. That's where you have your IRAs, your 401ks, your 403bs, your pension plans. The difference between that bucket and the taxable bucket is that in the taxable bucket, the money that you put in, you have already paid taxes on that money. And then every year, you're going to receive a 1099 from the institution that you put the money in with, which will determine if you had a gain, then you'll have to pay taxes on that in the taxable bucket. The tax-deferred bucket works totally different. The money that you put into your 401k, your IRAs, you put that money in on a pre-tax basis. The money grows tax deferred, but then when you pull it out, you're going to have to pay taxes not only on the contributions, but also on the growth of those contributions over a 10, 15, 20, 30, 40 year period. And because of the tax liability, then obviously there are some guidelines as to how much money you should keep in that tax deferred bucket from a business perspective. Your tax-free bucket, the money going into that bucket is after-tax money. The money grows tax deferred, but then when you pull it out, will be totally tax-free. And there are only 4 vehicles under the IRS code that will fit into the tax-free bucket. You have your municipal bond funds, you have your Roth IRAs, you have your Roth 401ks, and you have your 7702 plans, which are your cash value life insurance plans. Now, of the 3 buckets, the one that most of my clients, when they come in to see us for the first time, the buckets that they do try to maximize the most would be the tax deferred bucket. Now, unbeknownst to them, there are a lot of liabilities with that tax deferred bucket that I'll share with you in the next few minutes, but the vast majority of the clients that we engage really do not have and have never had the ability to maximize the tax-free bucket. And then once they understand it, then they want to start really filling in that bucket to the very, very top in order to minimize their tax liability in the future. Now, your taxable bucket, the most you want to keep there is 6 months of fixed expenses. And the reason for that is because you're going to have to pay taxes out of that bucket, you know, as long as you have a gain every single year. And many of my clients are paying way too much money in taxes that they really didn't need to. Now, you may want to keep a little bit of a buffer if you're thinking about making an investment and you want to have readily available assets and money that you can pull the trigger on at any point in time. Then you may want to buffer that bucket a little bit more, but not too much. So at the end of the day, the rule of thumb would be do not keep more than 6 months of your fixed, sometimes even your variable expenses in that particular bucket. Now, the tax deferred bucket, that's a one that, you know, needs to be really taken into consideration. Now, one of the things that we try to do from a tax planning and from a tax forwarding perspective is we want to limit the amount of money that our clients maintain in that bucket. Traditionally speaking, no more than $600,000 should be in the tax deferred bucket. In a perfect world, it should be somewhere around $500,000. So if you fall between $500,000 and $600,000, then you're right there. But anything above that will create all kinds of different issues and taxations for you, your family, and your business at some point in time in the future. Now, contribute if you happen to be an employee and your employer offers you the ability to put money into a qualified plan like a 401k, well, you should contribute dollar to dollar up to the match, but never more than 7%. And I'll explain the reasons for that in the next few minutes. Many of my clients have been putting in a lot of money into that tax deferred bucket. They have been contributing 10, 12, 15% of their income to that tax deferred bucket, and they don't realize the challenges they're going to be facing in the future because of that excess contribution to the tax deferred bucket. In 2018, the most that you can put into a 401k would be $18,500. You can also do an additional, what they call a catch-up contribution. If you happen to be over the age of 50 and over, you can do an additional $6,000 of contribution for a total of $24,500. Obviously, if you are putting money into an IRA for 2018, the most that you can contribute is $5,500. Plus, you can also have a catch-up contribution if you happen to be age 50 or older of an additional $1,000. Now, for 2019, the numbers will go up a little bit. So contributions to a 401k, the maximum will be $19,000, and again, $6,000 for the catch-up. And then for the IRA will be $6,000 with, again, $1,000 for the catch-up. Now, one of the reasons, and why we want to make certain that we can manage the tax deferred bucket is that when you start pulling money out of this bucket, not only do you have to pay taxes on the money coming out of that bucket, but depending on how much money you may be forced to take out of that bucket under the IRS code, it may actually create additional taxations that we'll discuss in the next few minutes that the vast majority of Americans have never ever considered. See, the main reason why Americans are putting money into their tax deferred bucket is because they're being told by many pundits out there in the marketplace that when they put money into the tax deferred bucket, they're saving money on taxes. And there are no savings in taxes. What you're doing when you put money into a tax deferred bucket is you're deferring the tax. The problem with deferring the tax is also deferring the tax liability. And when you look at the tax, what this country looks like today, and when you look at the national debt, which exceeds $21 trillion, and the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and interest on the national debt is exceeding $114 trillion and counting. The vast majority of Americans and the vast majority of the clients that I deal with feel very strongly, just like I do, that there's going to be a very, very high probability that taxes are going to have to be a lot higher in retirement in the next 10, 15, 20 years, because otherwise our country is going to have some major financial troubles and may even go bankrupt. So again, be careful when you're deferring the tax, because you're also deferring the tax liability. Now, the tax-free bucket, obviously, you want to try to maximize contribution to that bucket, whether it's through a Roth IRA, Roth 401ks. A 7702 plan is a great tool. Cash value life insurance enjoys some of the biggest tax benefits under the IRS code. We don't have the time to go into a lot of details on that. Just be aware that Roth IRAs, Roth 401ks, and 7702 plans are critical if you want to minimize and eliminate your taxes in retirement. Now, another feature of a 7702 plan is that it can help you reduce your exposure to the fatal 4, which we will discuss in the next few minutes. Now, some of the other accounting tips, let's say retirement distribution planning. You know, many of the clients that we engage are now approaching retirement. Some of them are already taking a retirement distribution. And you have to be very careful when you get ready to start taking distributions, because the tax penalties and the tax liabilities may be enormous for you and your family. So if you're turning 70 and a half in 2018, you must take required minimum distributions no later than April 1st of 2019. So if you turn 70 and a half in 2018, the IRS allows you to avoid having to take the distribution in 2018, but then you must take the 2018 distribution by no later than April 1st of 2019. Now, tax forward calculation planning comes in very handy, because the problem of delaying the distribution in 2018 to 2019 is that in 2019, you're going to have to take 2 distributions. You'll have to take by April 1st of 2019 the 2018 distribution, which you did not take in 2018. But on top of that, by December 31st of 2019, you must take the 2019 distribution, and then every year thereafter by December 31st. So what if you have to take 2 distributions in 2019? What is that going to do to your taxable liability if you're going to be in retirement? So if you don't have the tax forward planning calculation software, it's going to be very difficult. Now, you can try to do it manually, but it's going to be very difficult for you to determine whether it makes much more sense to take the 2018 RMDs in 2018 and then the 2019 RMDs in 2019. Obviously, if you happen to be investing in a Roth 401k, you know, a number of my clients have been putting money away in a Roth 401k. Now, they feel that, if you're in a Roth 401k, then you can avoid the required minimum distributions, and the answer is no. Only Roth IRAs will allow you to avoid the required minimum distribution. So that means that if you have a Roth 401k in 2018 and you retired in 2018, you must take a required minimum distribution out of that Roth unless you're able to move that Roth 401k to a Roth IRA. So be very, very careful, because obviously the penalties could be enormous. By the way, if you don't take the required minimum distributions once you hit the age of 70 and a half, then the tax penalty would be out of that box, it will be a 50% penalty. So not only do you have to avoid the 10% penalty for premature distributions out of the tax deferred box prior to age 59 and a half, but then at age 70 and a half, you need to start taking distributions whether you need the money or not. So be very careful, because when it comes to the tax deferred drawer, the majority of the products inside that drawer or inside that bucket, you only have flexibility for 11 years out of your entire lifetime, from 59 and a half to 70 and a half. Anything above or below that, there are all kinds of rules and regulations and penalties that you need to be very careful. So in a perfect world, you want to have as much money. The bucket that should have the vast majority of your assets should be the tax-free bucket from a taxable and business perspective. Obviously, you can also do qualified plan conversions. Now, you got to be careful, because when you do, let's say, qualified plan conversion, you're going from a traditional IRA to a Roth IRA, you have to be able to pay the taxes today. So if you're going to do any conversion now, be careful how you do so. If you do tax forward planning, it'll make it a lot easier. It'll actually determine how much money should you be able to convert every single year in order to minimize your tax liability. Now, obviously, once you do the conversion, then the money is going to grow tax-free in that Roth IRA for the rest of your life, and you're not going to have to touch it unless you really want to. So the Roth features and the 7702 features allow you to keep control of the distribution and the distribution rate of your finances and your retirement assets at some point in time in the near future. What are some of the other accounting and financial tips? And hopefully you're writing some of these down. Provisional income calculations. Most of the clients that we engage don't realize that depending on what your tax liability is going to be in 2018, if you're already taking Social Security benefits, a portion of those Social Security benefits may be taxed. Now, if the only income that you have coming to you and your family in retirement comes from Social Security benefit, then no taxes are due. What creates the taxation for your Social Security benefits is the additional taxation that you may have to report in 2018 that has to be factored in to determine what percentage, if any, of your Social Security benefits will be taxable. Now, how is that calculation done? Again, when you do tax forward planning, you have the ability to do that, but you're going to have to take all the ordinary income that you're going to generate in 2018, all the capital gains that you're going to be generating in 2018, the income that you may be generating from municipal bond funds or municipal funds, because although you do receive the income from municipal bonds on a tax-free basis, that income is added on to the provisional income calculation to determine what percentage, if any, of your Social Security benefits will be taxed in retirement. And then obviously you have to take 50% of your Social Security benefit, and then once you compile all that income in for the year, then if you are below the threshold, depending whether you're married or you're filing as a single filer, you may or may not have to pay taxes on your Social Security benefits. In a best case scenario, the tax liability on your Social Security benefits should be zero. In the worst case scenario, could be almost 85% of your Social Security income may be reportable for tax purposes for 2018 and 2019 and beyond, unless you've done proper tax planning and you have been able to keep a balance between your taxable bucket, your tax deferred bucket, and your tax-free bucket as you move closer and closer to retirement. Now, what are some of the benefits of a tax preferred retirement blueprint? And this is something that we do, for many of our clients. Well, if you do, proper tax planning and you have a customized tax preferred retirement blueprint in front of you that you and your tax preparer can look at every single year, then obviously you can reduce and or eliminate all of your taxes in retirement. Obviously, you'll have a balance between the three taxable buckets, the tax deferred bucket and the tax-free bucket that we've discussed. And obviously, you may want to reduce and or eliminate your liabilities under the Fatal Four. The Fatal Four for us, from a tax and risk management perspective, are the four major things that may happen to any of us, not only to you, but also to me and my family at some point in time in the future. The risk of dying too soon, the risk of living too long, the risk of living with a disability, and last but not least is the risk of living with eroding factors like taxes, inflation, stock market volatility. We've seen quite a bit of that now, interest rate volatility, and the like. So obviously, if you have a customized tax preferred retirement blueprint done for you, it also encompasses the ability to do tax planning and to do risk management planning in order to help you reduce and or eliminate the liability of the Fatal Four that are so critical for all of us when it comes to retirement distribution planning. What are some of the other accounting tips? Well, what if you happen to be a business owner? What are some of the tax strategies? As you can see there, if you want to reduce your taxes in 2018, then it may be suitable for you to purchase or lease, equipment in 2018, because obviously that would be a business deduction from a business perspective. What if you can make your necessary fourth quarter payroll tax deposits in 2018 as opposed to January 15th of 2019? So if you're able to pay the tax in 2018, then you can take a tax deduction in 2018 along those lines. Another thing that you may be able to do is, try to avoid collecting your receivables in the last quarter of 2018 and push those onto 2019 if your interest is to reduce your tax liability in 2018. But again, unless you can do tax forward planning calculation, it's going to be difficult to determine whether does it make sense, to take the receivables in 2018 versus passing them on to 2019 and so forth. Any passive losses you may have, are they going to be deductible in 2018? Try to maximize as much of those as you possibly can, and verify your operating losses for 2018. Make sure that you do the proper calculations, carry back, carry forward. These are things that your accountant or your tax preparer should be able to do for you in order to help you and your business minimize and become more efficient when it comes to taxes in 2018. Charitable deductions, whether they happen to be cash and non-cash. And obviously, if you happen to be self-employed or you happen to be a business owner, you consider the opportunity of providing employee benefits to your employees. Number one, that's a benefit to your employees. They will appreciate that. And number two, you're going to be able to take a tax deduction. For certain employees, depending on the kind of income that they generate, depending on where they're at in your hierarchy, let's say middle management, upper management, and so forth, you can put together for them bonus plans or GIBAs, where what is known as golden executive bonus arrangements, where you can set up an executive program, an executive bonus program for your key executives or your key employees in your company. And by doing so, you're able to retain key employees in your firm, but by the same token, you're also able to take tax deductions for 2018 and beyond for every year that you're making those executive bonus contributions on an ongoing basis. So it's a great tool. It's a great tool for you to be able to provide a benefit. to say thank you for your key employees in the corporation, for you to be able to retain them through a golden executive program that you can set up for them. And by the same token, you're able to take a tax deduction for the benefit of yourself, your family, and your business along those lines. And that's just a number. There's so many other things that we do for our clients and our business clients when we review their financial statements, but it does give us the ability to have a strong and suitable conversation along those lines. For 2018, obviously under the new Tax Cuts and Jobs Act, your standard deductions versus itemized deductions. For 2018, most of these deductions have almost doubled. So if you're married filing jointly, your standard deduction in 2018 has gone up to $24,000. If you're single, it has gone up to $12,000. If you're head of household in 2018, your standard deduction has gone up to $18,000. And if you happen to be at least age 65 or blind, there's another deduction that you can take for $1,300. Now, according to the IRS, less number of Americans are going to be itemizing in 2018 than ever before because of the increases in the standard deduction. So according to their forecast, 1/4 or approximately 25% of Americans will be itemizing. Obviously, if you need to itemize because your deductions are going to exceed your standard deduction, then obviously you can take the itemized deduction instead of the standard one. But more and more Americans are going to be using the standard deduction as opposed to the itemized deductions from a business perspective. Now, we talked a little bit about the importance of having and the benefits of having a customized retirement blueprint, but what does it really entail? What does it really provide to you if you're able to engage, let's say, with our firm, which is our specialty in creating a customized tax-preferred retirement blueprint? Number one, we will do Social Security reporting. And the reason for that is that many times, many of our clients, and we catch them late in the game, but if we're able to catch them before they retire or apply for Social Security benefits, Social Security reporting will be critical because it will determine when will it be the best possible time for them to generate Social Security benefits while reducing the tax liability for those Social Security benefits for the rest of their lives. Number two, we do tax forward planning for every single one of the clients that we engage from an accounting and from a risk management perspective, and we do it every single year. Most important, we do 5-year tax forward planning, so it gives us the ability to, through this program, to determine what the tax liability for our clients is going to be not only in 2018, but 2019, 2021, 22, and 23. And that's very, very important because then you're able to do proper tax planning and keep more of your hard-earned money in your coffers as opposed to the IRS's from that perspective. We do income distribution planning. And this we do some more so for clients that are getting closer and closer to retirement because it's important to understand out of the 3 financial buckets, how income is going to flow and how we're going to be able to reduce the tax liability. And in a perfect world, we always want to reduce the tax liability to 0, and then at the very worst scenario to single digits from an effective tax rate. We also do financial tax bucket efficiency, and we have already talked about that, how to have the right amount of assets in each and every one of those buckets so it doesn't create any other issues and concerns. For instance, in the tax deferred bucket, if you have too much money, you have to take more money than you really want to out of that tax deferred bucket, your Medicare premiums may actually increase. See, none of the clients that we have ever engaged that were maximizing that tax deferred bucket have even thought about the negative impact that taking money out of that bucket would have on their Social Security benefits, on their capital gains, and on their Medicare premium in retirement. And many of them, sadly enough, by the time they find out is quite late. And then last but not least, we used a risk management software program, and we create a risk management fatal 4 report that will help you and your family and your business to mitigate, the challenges of the fatal 4, the risk of dying too soon, living too long, living with a disability, and last but not least, living with eroding factors like taxes, inflations, and volatility in the market, and lawsuits, propensity to consume, maintenance and expenses, financial fees, and the like. So obviously, we have just gotten to the very end. I always like to leave all of you, because many of you are going to use a playback if you were not able to attend this short webinar today for end-of-year tax planning and end-of-year tax tips to reduce your liabilities. That the call to action is, if you have any questions whatsoever, and it's okay if you're using a tax preparer, a CPA, or an accountant, it's okay. If you want to continue to use their services, feel free to do so. But if you have some concerns, if you have learned some things here that you had never heard about before, and you want to reach out to me, then feel free to do so. I'll schedule a 30-minute strategy session with you at no cost or obligation. You can ask me all the questions you have. Many times when we do these 30-minute strategy sessions with people like yourselves that are attending our podcast or seminars or webinars, they jot down a number of questions that they want to discuss. And then at the end of the session, they give us some thought. They determine whether they want to continue to work with their current advisors, or if they want to use our services, not necessarily for everything, but for some of the things that they feel are critical to them, their families, and their business, that the other advisor has not been able to address or be able to accomplish. As you can see there, if you want to reach out to me via phone, you can call me at 786-766-1042. You can also reach out to me at bert@gablestaxgroup.com. You can also send an email to bert, B-E-R-T, at bertsalazar.com. And then obviously feel free to go into our website, which is www.gablestaxplanninggroup.com to learn more about us. So again, let me go ahead and turn off the screen right now. And again, I hope that that you have picked up some interesting feedback and tips regarding how to minimize and maximize your income in 2018. Always remember that the #1 goal for us and for me is to kind of help each and every one of you change the way that you see things. Because when you do change the way that you see things, the things that you see change. So again, thank you so very much for giving us and giving me a few minutes of your time. Feel free to reach out if you have any questions, and we'll talk to you soon. Take care. Bye.